For what feels like forever, MarketAxess has been the undisputed champion of electronic bond trading. I mean, a real titan in fintech. But today, the company finds itself in a real fight for its crown. So for any investor looking at the stock right now, this is the story you need to understand. A champion facing its toughest challenger yet. The big question is simple. Is the king about to be dethroned?
Yeah, this is really the heart of the matter, isn't it? After this long, dominant run that made early investors an absolute fortune, you have to ask, is the magic finally over for MarketAxess, or is this just a temporary stumble before the next big run-up? Let's dive in and break down the evidence. All right, so to figure out where these guys are headed, we've got to look back at how they got here in the first place. You have to remember, this company was a true pioneer. They kicked off a technological revolution in the very old-fashioned, kind of clubby world of bond trading. The whole engine behind their growth was this one big idea: electronification. I mean, think about it. The bond market used to be run on phone calls, private conversations between traders. MarketAxess came in and built a digital superhighway that made everything faster, cheaper, and way more transparent. And this trend isn't over. It's still happening, which is a huge tailwind for the whole industry. So how do they make money off this? Well, their business model is actually pretty simple. They get paid on commissions. They take a tiny little slice of every single trade that happens on their platform. And when I say tiny slice, I mean it adds up. A whopping 87% of their revenue comes from this. Now, that's a fantastic high-margin business when trading is hot. But it's also a double-edged sword. It means the company's health is directly tied to market volume and, crucially, their ability to win those trades. So how did they build this kingdom in the first place? Well, they built a massive economic moat. And for MarketAxess, that moat was all about one thing: the power of their network. Okay, and this is the secret sauce right here. It's what we call a virtuous cycle, a classic network effect. It's brilliant, really. The more traders who joined, the more liquidity there was. More buyers and sellers. That made trading better and cheaper for everyone, which of course attracted even more traders to the platform. It was this self-feeding loop that, for years, looked absolutely unstoppable. And just to put a number on that, we're talking over 2,000 of the biggest players in finance, institutional investors, broker-dealers, all plugged into this one system. That's the foundation, that's the moat. But you know how these stories go. Every king's reign is eventually tested. And right now, that MarketAxess moat, it's under a full-on siege. This is where the story really takes a turn. Okay, now this is the chart that's keeping investors up at night. Just look at the trend in their absolute core market, U.S. investment-grade bonds. It's just tick, 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 down it goes. This is not a blip, it's a clear pattern. They are losing ground on their home turf. And hey, you don't have to take my word for it. This is the CEO, Chris Concanon, speaking. When the person in charge comes out and says something this blunt, "We are not pleased," you know the pressure is seriously on. It's a huge validation of what we're seeing in the data. So who's stealing their lunch? Well, it's kind of like a two-front war. On one side, you've got Tradeweb. They've been brilliant at integrating their platform deep into their clients' workflow, basically making it the easiest button to push. On the other side, you have the behemoth, Bloomberg. Their terminal is on practically every desk on Wall Street, giving them this massive, captive audience. Each one is chipping away at the MarketAxess castle from a totally different direction. And here's the part that's really got to concern investors. It's a double hit. It's not just that they're losing market share. They're also getting paid less for the business they do keep. Their average fee per $1 million traded has dropped because of intense price competition. It's a powerful 1-2 punch right to the company's profitability. But hey, a champion doesn't just roll over. MarketAxess is fighting back, and they've got a whole new playbook. They're launching a major counterattack. And what's the first thing you do in a war? You make sure you have the right general. They brought in a new leadership team, a wartime team, led by CEO Chris Concanon. This guy is a veteran of modern high-speed exchanges. He's not a caretaker. He's a specialist brought in for this exact kind of fight. So here's the game plan, broken down into 3 key moves. First, defend the core business by going after the really big, high-value block trades. Second, go on offense in something called portfolio trading, which is a huge growth area where they've been lagging. And third, open up a whole new front with a product called MKTX, which is designed to capture a part of the market they didn't really play in before. So the big question is any of this actually working? Well, Here's our first clue. A 69% jump year over year in their daily trading volume for portfolio trading. That's a huge number, and it's a critical sign that they're finally gaining some real ground in a key battle.
And that's not all. That momentum helped them smash a record, 22.5% market share in U.S. credit portfolio trading. These are the kinds of numbers the bulls have been waiting for. It's concrete proof that the turnaround plan isn't just talk, it's actually starting to deliver. All right, so all of this brings us right here to the final question for any investor looking at this stock today. We are at a classic inflection point where the story could break either way. Just look at this chart. It tells the whole story of market perception. Back in 2020, the market was pricing this stock for absolute perfection, paying over 70 times its earnings. Today, that valuation has been slashed to under 30. The market's entire view of this company has changed, and that's what creates the debate. And this is what it all boils down to. Two totally different stories about the same company. The bull case says you're getting a world-class business at a fair price, a champion that's just getting back off the mat. The bear case says you're looking at a fallen king whose best days are gone, whose moat has been permanently breached. So if you're an investor, how do you know who's winning this fight? Simple. You create a scorecard. And these are the 4 things you need to watch like a hawk. Number 1, that U.S. credit market share. Has the bleeding stopped? Number 2, fees. Are they still falling off a cliff? 3, are people actually using the new products like MidX? And finally, you have to watch the competition. What are Tradeweb's numbers looking like? This is your scorecard. And that's what it comes down to, isn't it? Is this a classic case of the market getting way too pessimistic, punishing a great company for a few bad quarters and creating a huge opportunity? Or is this the new reality for a king whose castle walls are starting to crumble? That's the multi-billion-dollar question investors have to answer right now.